Goldman Sachs out with a note saying you need sub 50 to constrain shale. Is this what the sell-off is about?
Well, it's a broader picture there, Alex. Essentially, the saying goes, we have in this country, you cannot swing a dead cat without hitting a barrel of oil. And that is to say that we'll go back and look at November when we did have the OPEC decision. It was a surprise announcement. Not many people, myself included, was expecting the cartel to curb back on their production, but indeed that's what they did. And what did we see, Alex, in December and January? We saw Wall Street speculators go all in on a bullish bet for higher oil prices. That did not pan out, and we've spent the better part of this year liquidating that bullish bet, and hence why we've seen and kind of prices have languished. So why are prices languishing at this point? Because it is clear, Alex, that when we look at the forward curves, when we look at global arbitrage markets, for instance, the link between Middle East crude, the Dubai-linked markets, and North Sea and North American crudes, markets that are linked to the ICE and the NYMEX crudes and a lot of West African crude, what we've seen is a dislocation in these spreads, and that is the clearest telltale that OPEC has failed miserably to balance this market. And if you are a bullish investor, that has to be a concern for you, because here in the United States, demand for crude oil has never been stronger than it is now. And that demand is going to remain strong well into the summer. So you have to ask yourself, if OPEC has indeed pulled back production, and by all indications they have, at a time when demand is record strong here in the United States, and you failed to balance the market, what happens towards the end of the summer when that demand, record demand, begins to fall off? And oh, by the way, U.S. crude oil production is well on its way to a modern day record. So it is quite an overhang for this market to overcome right now.
Right, Stephen, I'm glad you brought up demand. That is the short-term outlook. But there's a longer-term thing at play here as well, and that's really highlighted in the Exxon shareholder meeting today, facing questions from pension funds about the clarity of climate change. Bloomberg New Energy Finance put out a report, and I want to read you a little segment of it. It says, technology change, electric vehicles, clean energy push, which is what the IEA says would be required to limit global warming to within 2 degrees Celsius, would mean oil demand peaking around 2020, declining by about 20 million barrels of oil a day by 2040. That is 36 million barrels a day lower than the average oil company forecast for 2040. Stephen, are we in a peak demand world again? And when do you see that really coming in?
Well, I am not going to proffer any sort of forecast on when demand will peak, be it 5 years, be it 25 years right now, because what we've been taught in this market in oil, and this goes in general, Alex, for all of economic forecasting, the only reason why you make long-term forecasting is to make astrology look respectable. So what we can do now is take a more commonsensical view of the market, and clearly we have to recognize that the environment in this industry has changed. Alex, there are two things that move the price of a commodity. We've always had the one variable in the equation, and that is the price shock to the consumer, going back to the early 1970s and the 74 Arab oil embargo, and we've had it decade in and out since then. But we've always been missing that second variable to impact consumer behavior, the inelasticity of demand, and that is, of course, the substitute. Now, I'm not so sure if Tesla is the answer, but that genie is out of the bottle, and you're not putting it back in there. So that demand and those peak demand forecasts, that is derivative of 2 points. One, as we've just addressed, the advent of renewable fuels and the commercial success, depending on if we ever get there, is certainly going to impact future demand. And also, and this is what Exxon is vulnerable to in the current shareholder meeting, and that is the whim of politicians to create or dictate supply-demand economics by the stroke of a pen rather than letting the consumer take hold. So this is something indeed that Exxon will have to navigate. So I don't know, and no one can tell you realistically when demand will peak, but we do know this is not your grandfather's oil market, and clearly we have a lot of supply. The economics suggest we'll still see a lot of supply coming to the market, and that demand equation, look, I'll give you a little anecdote. I used to live in Greenwich, Connecticut in the early 1990s, right after the first Gulf War. What was the status car on Putnam Avenue in Greenwich? The Hummer, the car that got 300 yards to the gallon. What's the status car now on Greenwich Avenue? It is the Tesla, and that indeed is in the future, and that indeed will erode these forecasts of rampant demand growth. So yes, peak demand is certainly in the foreseeable future, but whether it's 5 or 25 years, your guess is as good as anyone else's.
Peak oil. The last time we talked about peak oil, it was about supply.
Yeah, that's
I mean, I remember living in Australia over a
Indeed.
decade ago, and I had a professor talking about peak oil, and he thought we were there, and that was it. And then this little thing called shale came around the corner, and there we have it. Stephen, on peak oil, the traditional way we talk about it, peak supply, 9.5 million barrels of oil a day was where we got to in the United States in the middle of 2015. And then we had the OPEC strategy to really try and wash this out. We're at 9.3 right now. I just wonder, how high can that go here in the United States?
Well, if you want to believe the EIA forecast right now and what they're telling you what the average is going to be, we're going to be over 9.5 million. So we're going to be at or near a modern day record, certainly by the end of this year, first quarter of next year. And again, with the EIA making its forecast going forward, we'll be at over 10 million barrels. So we will certainly surpass the all-time high, which was set in 1970 of peak supply here in the United States. And there's no reason to think that's going to change. And why I say that is that if we look at, one, the industry is well hedged. They are selling forward. So when we look at the action on the long-dated end of the curve, oil prices in 2018, 2019, 2020 has been very heavy selling every time we've gotten into that high $50 range. And when we juxtapose that anecdote with the CFTC data of what producers are doing in their short positions, it is clear that when we get oil in that high 50s, the market is telling us, shale producers inclusive, that they can, and they will make money in that high $50 range. So again, from a longer-term investment standpoint, if the producer is telling you they're willing to sell you oil between $55, $56 out for the next 5 years, why would you want to own it here?